Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, the reason I did it the way I did it is because what we want to avoid, as you saw in the profit and loss chart on the previous slide, is we want to avoid that zone between the top of the orange zone and this single orange line, that black area. That's where we don't want to be. Well, we can see that actually we're in that zone right now, right? This index was at 62.68 when I did this snapshot. Our break-evens are at 61.45 and 64.55. We're right in the middle of that, or pretty darn close to the middle. So that means if this thing goes nowhere, this trade is not going to make money. So I've got to have a bearish move in order to be profitable on this trade. It's got to drop from its current level of 62.68 to at least the top of the break-even, or to below the top break-even. I'm sorry, below the bottom break-even line of 61.45, and get into that orange zone in order for me to make money. And ideally, that's where I want to be. And anything in that big orange zone or below is going to be profitable. And in fact, the lower it goes, the better. So I'm relatively bearish here. Or if I'm completely wrong on this, and this thing rallies all the way up to where it goes above the upper max gain line, which is 65, and that's illustrated by the yellow line, then I'll get my consolation prize and I get paid 45 cents. So even though we are on a slide, and you can see by this chart that it's been moving lower for the last couple of weeks, if it gets back to where it's been in May and June and July, I'm going to be completely wrong, and I'm going to walk away with a small credit. It's not the end of the world. We can try again. But now if I want to be a little bit more aggressive, because I really believe this thing's going to drop a lot further, then I can put on a ratio back spread that targets a lower zone. So in this example, I've just simply lowered my strike prices. I buy 20 of the 61 puts. I sell 10 of the 63s. This one's done for about the same price, a net credit of 50 cents. You can see that the lower break even is at 59.50, which is the very bottom of the green zone, which is the very extreme bottom of the chart. And the upper break even is 62.50, which is the green line. The part that I want to avoid is the zone between the top of the green zone and the green line, which happens to include that big orange zone, but that's just left over from the previous example. So it's that whole range between that 62.50 and 59.50 zone. So you can see that if my lower break-even zone, if my lower profit zone doesn't start until I get down to the top of that green zone, which is at 59.50, this index has to go quite a bit lower in order for me to hit my profit zone. I've got to drop all the way from 62.68 down to 59.50 in order to make money. And anything below that's great, because that's where I'm making big money. And the lower it gets, the better. Whereas in the previous example, you can see that I only had to drop from 62.68 all the way down to 61.45. This one's going to require a couple of more points, almost 2 full points further downside movement in order to hit that max profit zone. So your goal here is to target this specific area where you think this is going to go. Now that might sound hard to do, but you don't have to be exactly right. Remember, you just got to get in that zone somewhere. Now if I'm completely wrong on this one, which is kind of interesting, where's my maximum profit to the upside for the consolation price? It occurs when both of these options expire worthless. In this example, that's going to be above 63, where both puts expire. Well, it doesn't have to go a whole lot higher in order for me to have that happen. Only about, 32 cents? So if this index rallies 32 cents or more by expiration, I would actually get my consolation prize, which occurs above that purple line, right? Right now I'm in the max loss zone, or the loss zone between that purple line and the top of that green area. But you can see that this, again, targets a specific area, but that doesn't make the trade more expensive. And what's nice about this trade is, again, you get to bring in a credit up front. So kind of a nice way to do it. So I realize that's a much more complicated trade than a simple vertical spread, but what I like about spreads so much is that they're so incredibly versatile, and there are so many ways that you can structure spreads to pretty much do exactly what you want them to do. You want to bring in a credit, we can do that. You want a debit, you want to pay a debit, we can do that. You want to have a profit when it goes up, when it goes down, when it lands in a certain zone, when it goes up or down, or when it just falls in between two levels. There are always a way that you can structure a spread of some sort to target exactly what it is you're trying to accomplish. It may not always be that easy to do, but it's actually, it can always be done, pretty much. All right, and with that, I think I finished up a few minutes early, but we'll go ahead and take any questions that you have right now on these strategies, or if you want to ask me anything else, I'll be happy to try to answer those as well. So Steve, you want to forward these questions to me, or you want me just to address these as I see them coming in? So one of the questions I see here is, can the probability of gain or loss be quantified? Here's my rule of thumb, and I haven't done this scientifically, but I've done it through years and years of examples and just figuring the way this works. On spreads specifically, and this isn't true for all option strategies, but on spreads, I've found that if you compare the maximum profit to the maximum loss, or the most you can make versus the most you can lose, like in some of these examples, like in that one I said, well, I can only make like $800, but I've got $1,500 at risk. I have found that if you compare the ratio of the max gain to the max loss, that's the inverse of the probability of making money versus the probability of losing money. So let me give you a simple generic example. If I put on a spread that has a maximum gain of $500 and a maximum loss of $2,000, that means that I can lose 4 times as much as I can gain. What that tells me is that there's a 4 times greater likelihood of making money than there is of losing money. And it's for that reason that the more conservative the trade gets, the greater the chance of making money, the smaller the amount of money is that you can make. So just simply take the ratio of the max gain to max loss and flip it upside down, and that's the ratio of making money versus the ratio of losing money. Now, that's not true, again, for all strategies, but for spreads, that works quite well. So the question of how can you use a spread like this for a spot position? Well, I think Steve talked about this a little bit before we got started, and that is that if you trade spot currencies, and you may have a position in a spot currency, you can use these strategies to hedge a long dollar position. The only thing you have to be aware of is the margin requirements, right? You can't actually write a covered call against a spot position. So if you put on a spread, you're going to be subject to whatever the margin requirements are for the spread. Now, in your net aggregate of all your positions in your account, or even in multiple accounts, the total risk to you may be a whole lot less than that margin requirement. But from the perspective of your broker that allows you to trade these options, like if you're at Schwab, we don't have the ability to see that spot currency position, and we aren't allowed to use it as underlying collateral for the position. So if it's a simple spread, well, you'll be subject to whatever the spread requirements are. If it's a ratio spread, like in the first couple of ratio spread examples I gave you, where part of the spread position is naked, we have to hold you subject to the naked option requirement, margin requirements. That's industry regulations. So from your perspective, the only downside is you got to tie up capital. That's it. Your risk might not be nearly as high as the capital requirement would dictate, and so from your perspective, you're hedged, but you're going to have to tie up capital in the meantime in order to carry those positions.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.